welcome. Sorry for the glitchy screen at the start, not a strong start. It'll go away in a second. This is Taxes in Retirement. I am Andy Panko, owner of Tenon Financial. And there we go. Finally, it's down. So here goes nothing. This is going to be the first of what I'll call the mailbag episodes, where I will take whatever questions you all have, and I do have a handful that were sent in prior to now. So I will go through those first. Otherwise, pop your questions in the comments to the post. Now, if I can just ask, normally the comment section is kind of a free-for-all, where as I'm running through my bit, some people are asking questions, others are responding to those questions. The streaming software I'm in now doesn't nest responses and replies to questions. I only see every single comment and response as its own line item. So if I can just ask you all to refrain from commenting and answering other people's questions, just because it'll confuse me from being able to see who responded to what and not. So typically I appreciate that for people to help out, but for tonight, let's I see a few people posted. Cody Garrett live, David Fultz, howdy, hi. So for those of you that do have questions, please type them as a question in the comments to this post, to this stream, and I can then pull up your question and overlay it on the screen when it is time, and I will address it after first going through the handful that I got from other folks. So curious to see how this will turn out. I did not prepare for any of this other than the few questions I already had sent ahead of time. So those I have some coherent responses for, but otherwise, there's a real good chance I may not know the answer, or I'll only know some of it, or I'll at least maybe reference you where else to go to get the answer. But I will do my best. Hopefully this doesn't blow up in my face. I thought this would be something cool to try. We'll see what happens. As of now, I'm planning on doing it once a month, but we'll see. Kind of making this up as I go, so I'm sure there'll be ways for me to streamline and make this better as we go. So let me start with the dad jokes quick. Bullets are quite weird indeed. They only do their jobs after they're fired. Did you hear about Dave? He fell into an upholstery machine. He's fully recovered now, upholstered. And what did the grape do after he got stepped on? He let out a little wine. All right, silly grape. Okay. Disclosure, super important today. It's always important, but especially today. This video is only general explanations and education. It is not specific tax, legal, investment advice. I repeat, it is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. So I am neither your tax, legal, nor investment advisor. I'm just some guy on Facebook trying to give helpful hints and education and give some general guidance and answers to otherwise broad questions. None of this is specific to you or your circumstances, so keep that in mind. Okay, so let me start. And also I have, for those of you new or not familiar, I do have a YouTube channel. I'm not saying this just to plug myself, but a lot of the questions and things we discuss presumably tonight and throughout the group, there's dozens of videos on my channel, and I intentionally created videos that were common questions that people ask about when it comes to retirement planning, specifically sort of tax-focused planning. So I have, let me just show you quick. Definitely go there. I may refer some of you to some of the videos tonight. It's not going to work. Never mind. Forget that. Yeah, forget that. But anyway, yeah, so if you go to YouTube and search up Retirement Planning Demystified, you'll find it there. Lots of good, deep educational videos about lots of things we discuss in the group. First question is from David Fultz. Pretty wordy. I'll see if I can spit this out quickly. With respect to the Roth IRA conversions and the quote-unquote tax torpedo, I'll explain what that means in a moment. Are there any exceptions to the rule of doing a conversion in the lower tax brackets prior to RMDs, such as the federal tax rate will actually go lower as opposed to higher in the future? The couple decides to both take Social Security early, or assets that are transferred from the IRA to the Roth, such as bond funds, do not grow enough to justify the taxes incurred from the conversion, and then some niceties after that. Okay, so general question from David Foltz is, does it ever make sense to not do Roth conversions in the earlier income years, lower taxable years? The answer is a great question, and the answer is it really all depends. There's a few things we know for certain. One is we know federal tax rates are going up in 2026, if not sooner. And the reason why it's 2026 is the Tax Cuts and Jobs Act that went into place effective 2018 reduced federal tax rates a few percent. And it was already pre-programmed that these rates will go back up in 2026 to the 2017 levels. So that right there, we objectively know tax rates now are a few percent lower, federally at least, across the board. And they will be going higher. Now, couple with that there was already large deficits or increase in deficits, spending federal deficits created for various reasons, but they weren't made any better as a result of the reduced tax rates of the Tax Cuts and Jobs Act. I like paying low tax as much as anybody else, but these current levels are just unsustainably low, creating more deficit. So the fact that we have these low levels means taxes are going to have to go up, probably even more than the scheduled amount they're due to go up to help pay that off, and add to it now the few $1 trillion of stimulus money that were created in the last year because of the pandemic. We're going to have to attempt to pay that off at some point. So taxes, I firmly feel, have to go up even further above and beyond the pre-scheduled 2026 increases. Where am I going with this? The goal with Roth conversions is if you're in a year where the tax rates now are lower than they're going to be in the future, and or if you have less taxable income now than you will in the future, it's a good thing to consider getting ahead of your tax deferred monies, like your IRAs, your 401ks. Don't just let it all sit there so that you'll have to start taking it out at some point in the future and pay tax on it then. Have some control over when you pay tax on it. Do some of it now if it makes sense. We know tax rates are lower. That's good. That's one of the two check boxes. The other one is your taxable income now lower than you anticipate it will be in the future. Now that's specific to you. So one of Dave's comments is if you delay Social Security, then your income now is lower than it will be in the future when you do start it. So Dave's comment was, well, what if one or both spouses have to start Social Security earlier for whatever handful of reasons? Does that now sort of get rid of the benefit of doing conversions, or at least reduce the benefit? And the answer would be yes. All else equal, you now have more taxable income currently than you were planning on because you're starting Social Security earlier. So that's one example, Dave. There's lots of different ways to tweak this, but the gist is if for whatever host of reasons, you have more income now than you anticipate you will in the future, you may not want to do conversions, or at least, not a lot. As far as taxes, taxes being lower in the future, I really can't fathom that. Now, I'm no seer or soothsayer or whatever it is. I don't foresee how it's possible that federal tax rates will ever be as low or lower than they are now, which I think is a once in a lifetime thing for any of us alive currently watching this. So I wouldn't bank on tax rates ever being lower. Now, I could be wrong, but I can't picture that. But as far as your taxable income, is it lower now than it is in the future? Possible. That's all up to you. Good question. Thank you, David Foltz. Here is an interesting one. Not so much part question, part example. So the question is from Sarma, and I got this offline from her, basically about Social Security taxability. So in a nutshell, at the federal level, no more than 85% of your Social Security benefits will be included in your taxable income. That doesn't mean you don't pay tax of 85% of your benefits. It just means if you get $100 in benefits, no more than 85 of them will be included as taxable income. The formula to figure out how much exactly is included, devilishly difficult. Seems simple on the surface, but it's not this neat, pretty linear thing. And I actually have a quick example. I'll run through some very high level numbers just to show you how hard it is to guess where you're going to fall out. All right, so I made up this little spreadsheet. It's a mock 1040, form 1040. Let me just do it here so you all can see it. Getting there. One of the fields I calced is how much of your Social Security is taxable. So it's called the measure of income that you use to figure out how much of your Social Security is taxable is a measure called provisional income, provisional income. It's basically half of your Social Security benefits plus all of your other taxable income plus your tax exempt interests like municipal bond interests. And based on these combinations of income, there's these thresholds that say anywhere from 0 to 85% of your Social Security may be taxable. So let's just start playing with some numbers. Tax year is 2021, you're married filing joint, neither of you are over 65, let's say. And let's assume collectively for your household, you have $40,000 of Social Security income. Your provisional income, again, you don't really have to worry about what that is. It's just a measure behind the scenes to figure out how much of your Social Security is taxable, is 20. And you have, so this is your gross amount of Social Security. This is your taxable amount is 0. And I got formulas and spreadsheets behind the scenes that do all this, but the point is it's 0. So if your only source of income is 40 grand of Social Security benefits, you have 0 taxable income. Let's up this. Let's assume you have, between you and your spouse, you have $60,000 of Social Security income. None of it is taxable still. So if this is your only source of income, good for you. You have 0 federal tax obligation. What if you have a pension? You have 20 grand of pension on top of your 60,000 of Social Security. All of a sudden now, the way the formula works, 18.5% of your 60,000 of Social Security is now taxable, such that in addition to your 20 grand of pension income, you now have $11,100 of taxable Social Security income, such that your total adjusted gross income now is 31 grand. And watch how this percentage rises. So the more pension you have, so let's assume you have 30,000 of pension. Now 32% of your Social Security becomes taxable, such that there's, of your 60 grand gross Social Security, 19.6 thousand is taxable. And this number ratchets up pretty quickly. So 50 grand of pension, now 61% of your Social Security is taxable. Let's just keep going. Let's assume you have 80 grand of pension. And boom, you're now maxed out. So now you have the full 85% of your Social Security is taxable. So of your 60 grand of Social Security, 51,000 of it's taxable. Oops, sorry. Add that to your $80,000 pension, and you now have 131,000 in gross income. So this gets back to Dave Fult's comment, and I said, hold that thought when he mentioned tax torpedo. What does that mean? So Social Security, as we saw before, look, if that's your only source of income, all 60,000 of your Social Security is completely thrown off your tax return. It's not taxable at all, I should say. The more other income you have, the more your Social Security starts to get pulled into taxation, to the point that you have $50,000 of pension. What am I doing? 61% of your Social Security is taxable. For every additional, let's say, $5,000, your pension is now $55,000. You just pulled in another 4 grand of your Social Security into taxation. So that's a tax torpedo. It's like the more other sources of income you have, the more it pulls your Social Security into taxation, so that your effective tax rate keeps stepping up and like torpedoing. Let me leave it there. I can go on forever with these scenarios and what ifs, but the point is, Sarma, anywhere up to 85% of your Social Security may be taxable federally. How much exactly is a function of your other sources of income. The more or less you have of those, the more you're going to vary somewhere in between 0 and 85 for your Social Security. So hopefully that helped. You can find, just Google, you can find calculators like this about Social Security taxability, and you can, get something like this for your very own to play around with it. Or just when you do your tax returns, all tax prep software do this automatically, neatly and easily behind the scenes. So you don't have to worry about doing it yourself like I'm doing it here. All right, cool. Let me stop sharing that. Next question. All right, question from June Wang, posted in the Facebook group. Can you pay health insurance premiums with a FERS annuity pre-tax or with an HSA? So FERS annuity is just simply a federal pension for those who are federal employees. FERS is their pension system. FERS annuity, just traditional pension in effect. So the question is, I think if you're retired from federal employment and you have a FERS annuity, i.e. a government pension, and that was all pre-tax money, so you have to pay tax on that pension when you get it. Can you use that to pay for health insurance premiums? And can you do that in a pre-tax or non-tax way? I think that's what the question is. And the answer is depends. So if you retire from federal government, and you start a job as a consultant or any other sort of self-employment, in that case, then maybe you can deduct your medical premiums, your health insurance premiums, as a self-employed business expense. In that case, I would view that as you're paying for your healthcare with pre-tax money because it saves you income that you'd otherwise have to pay tax on. So that's one example, but that really has nothing to do with your FERS pension. That's just an example of how your health premiums can be tax-free in essence, or pre-tax. Outside of that, if you're not self-employed and you're receiving your federal government pension, June, no, I don't think there's a way you can just directly siphon off that money or use it to pay for healthcare premiums, unless there's something specific about federal pensions and the federal benefit program I'm not aware of. If you're just talking about buying your own private insurance somewhere, then no, I don't think you can. Now, you can potentially deduct your healthcare premiums and any other out-of-pocket medical expenses you have if you itemize your deductions on your tax return, and only to the extent that your total medical expenses exceed 7.5% of your gross income for the year. Then you can deduct the amount in excess of that 7.5% figure. Otherwise, no. And your second part of the question, can you pay health insurance premiums with an HSA, health savings account? The answer also depends. So the standing answer is no. HSAs cannot be used to pay for healthcare premiums, but there's a few exceptions. And I refer you to IRS publication, 969, that details this all out. The few types of health premiums you can pay with HSA money are long-term care insurance premiums, COBRA. So if you left or got laid off from a job that you had coverage and you can extend it, up to a year and a half, typically, you can use the HSA to pay for those benefits while you're on COBRA. You can pay for health premiums, health benefits, if you are receiving unemployment. So not just out of work, but out of work and receiving unemployment. Then you can use your HSA to pay for health insurance premiums. And the last one, you can use your HSA to pay for Medicare premiums, but only base Medicare, not Medigap supplemental premiums. So all these things have exceptions and exceptions to the exceptions, but the answer is, generally speaking, no, you cannot use an HSA to pay for health insurance premiums unless it's one of those few examples I just mentioned. Good question. Thank you. Question from Bud Blower. This one I don't quite know the answer, but and this has to do with the new American Recovery, the new legislation that's likely getting signed into law tomorrow by President Biden. And this whole thing is a huge monkey wrench right in the middle of tax season. There's a lot of moving parts. There's going to be a lot of potential planning opportunities and tax return amendments and other things to do. It's not cool that they do this right in the middle of tax season, but whatever, it is what it is. So the question is, with the quote unquote reopening of the ACA exchange, healthcare.gov, through the end of May, if one has a plan through the program now, which does not qualify as a high deductible health plan, and therefore not eligible for 2021 HSA contributions, would switching to a high deductible health plan before May 31st, now that the ACA is reopening, would that allow for a full year deductible HSA contribution? So just to recap, an HSA is a health savings account. You can only contribute into it if you have a qualifying high deductible health insurance plan. Bud's question is, he does not currently have a high deductible health insurance plan, but may get one in the near term, next couple months or whatever. If he then gets one, can he then make a full contribution for the full calendar year 2021? I don't know this with certainty, but my strong, pretty good level of conviction answer is no. You won't be able to retroact, or you won't be able to make an HSA contribution for the full year. The way the HSA contribution eligibility has always worked, and there may be some minor exceptions I'm not thinking of, but basically you can only contribute for months where you actually have qualifying high deductible health coverage, bud. I don't know this for a fact, but I wouldn't think any changes going on now with reopening of the ACA for this year would, unless this is written into the law, and I'm not aware of it, the new law, wouldn't change that. So if you sign up for a policy in May, you'll only be able to contribute the last, May through December. You can't make contributions for April, January through April. At least that's my guess. Not 100% certain on that. Good question. All right, a couple more questions that I received up front. Kim Gunter, how do you report the earnings on excess Roth contributions for 2020 if you won't get a 1099-R until 2021? Yeah, it's a good one. So here's a scenario. Let's assume in 2020 you make $6,000 of Roth IRA contributions, because that's the annual cap for people under 50. But in doing your tax return now, February, March, whatever, you realize, oops, I made too much money. I wasn't able to actually contribute $6,000 to my Roth last year. I was only able to contribute $4,000. There's a fix for that, thankfully. You can call up the custodian that has the Roth and say, hey, I contributed $2,000 too much. Can you please send it back to me? I made a excess contribution. Standard process that will send you back those $2,000. But here's the wrinkle. Any earnings that you made on that $2,000 while it was in there, you'll have to pay tax on that, and potentially the 10% early withdrawal penalty if you're under 59.5. So the example would be, let's assume January 1st of last year, Kim, you made a full $6,000 contribution to your Roth on day one, January 1st, 2020. That money did really well over the course of 2020. Stock market, had a nasty March, but rallied hard and ended up quite strong for the year. So let's assume that $6,000 grew to $8,000. Now you do your tax return. You're like, oops, I was only able to contribute $4,000. So anyway, so $2,000 of your original contribution needs to come out, and all of the gains attributable to it. I can't do the math that quick in my head too. So like $666 of the $2,000 of gains would need to come out with it, because the $600+ of gains were attributable to that $2,000. You'll get that money back this year, and you have to report that earnings as 2020 income. Even though you got the earnings back in your hand in 2021, it was attributable to a 2020 contribution. So your earnings need to get reported on your 2020 tax return. Complicated, right? Here's the pickle. You're not going to get a 1099 from your custodian until next January, showing that they sent back the earnings now, but those earnings are for 2020. So here's what I'm pretty sure needs to happen. I've done this with 401s. I've never had to do this with a Roth personally, so I can't personally attest to this. My understanding is that $600 of earnings you got now that you need to report for 2020, you would have to add that to your return as like a other income item. I'm not sure what software you use and where exactly it's going to go, but the gist is you do need to report it. And again, if you're under 59.5, it's subject to the 10% penalty. So I'm not quite sure how you plug that into your software and make that all work, but you should report it now as 2020 income on your 2020 return, even though you will not have a 1099 for it. Fast forward next year, when you do get the 1099, the 1099 will show, it'll be coded that it was actually income for 2020. So the IRS will know to not flag you for it when they get your 2021 return, and it's not showing that income, because you will have already reported that income on your 2020 return. Not the easiest thing to resolve and fix, especially if you've never done it before and you're not sure where it goes in the tax software, but that's basically it. You have to manually get it added into your 2020 return by whatever means you do that, Kim. Great question. Okay. Three more, and that's it for the canned questions. Douglas Schobel, I recharacterized my 2020 traditional IRA contribution into a Roth. and didn't take any deductions for said contribution. So that was in 2020. He made a regular IRA contribution. It was moved to my Roth with earnings today. Okay, so the original contribution is $6,000 plus earnings. So let's assume you got $1,500 in earnings. Question is that earnings taxable or is it not? So a recharacterization is in 2020, some point, Doug made a $6,000 contribution to his IRA. You're allowed to recharacterize that. You can say, you know what? I didn't want that to be an IRA contribution. I actually wanted it to be a Roth IRA contribution. You can do that after the fact, up until you file your tax return, by April 15th, which may get extended if you ask me, but that's just speculation. Don't bank on that. Forget I said that. Still do your tax returns as normal, but I wouldn't be surprised if the IRS bumps it out again, considering these changes that they're about to put in place. So no, short answer is no, Douglas, it's not. You can basically do your recharacterization as you did, as if that money was in your Roth all the while. The earnings that happened in your traditional IRA will just, that and your contribution, your custodian will just plop over into your Roth. No harm, no foul. Basically like it was in Roth all the while. That simple. So you won't have to report it as the gains are not taxable income or whatever. So that's that. Next to last question. Linda Robinson Nelms asked here, from your perspective as an enrolled agent, and I'll explain what that means, what are your thoughts on becoming one to have a part-time tax prep income stream in early retirement for someone who tends to be more interested in income taxes than the average person? So first, what is an enrolled agent? Enrolled agent is a license/credential overseen and governed straight from the IRS. It's the highest credential the IRS grants to people. You have to take 3 different tests issued by the IRS, and there's a boatload of continuing education to do every year. But basically, that's what it is. And it also, in addition to making, evidencing you have strong knowledge of taxes, it also gives you the ability to represent people in front of the IRS. So if the IRS comes after you and says, hey, you owe me 20 grand in back taxes, an enrolled agent has the same representation rights as lawyers and as CPAs to represent you, the client, in front of the IRS and defend you in front of the IRS to try to, whittle down or argue against this tax penalty. So the question is, what's my thoughts about becoming an enrolled agent and or doing tax returns as a part-time side hustle in retirement? It's like any other job or side hustle. If you like doing it, then sure, why not? It's frankly, it's concerningly, the hurdle to become a paid tax preparer is concerningly low. I mentioned this in one of my videos on YouTube and in the group before. In order to legally do someone else's taxes for money, all you need is what's called a PTIN, a PTIN, which is the ID number you get from the IRS. In order to get a PTIN, all you have to be is 18, have a valid social security number, be current on your own taxes and returns, and not be convicted of certain felonies. There's some felonies you can be convicted of. I don't remember which ones, but others you can't. I think like money laundering, fraud, stuff like that. Hopefully murder. If you meet those 4 things, you can be in the business of doing other tax returns. Frightening. There's 0 experience, testing, knowledge, credentials whatsoever. Anyway, so yes, if you want to do taxes, sure. You can easily get in over your head, as I found out the hard way. Tax returns are fairly straightforward when they're easy. When they're not, they're huge rabbit holes to have to dig down and research things, especially doing state returns. Federal returns aren't that bad because it's the same no matter where you live. It's the state returns that get nasty and ugly, especially if someone changed jobs mid-year in different states or moved mid-year. And if you're not 100% already comfortable and up to speed with a certain state, and you have to learn a new state's tax rules for the first time, especially with one of these more complicated scenarios like changing residency, that gets ugly fast. So it's good and it's bad. If you have the time and you enjoy the research and you enjoy learning about taxes, yeah, it could be a good thing to do. But it can be frustrating and make you want to bang your head against the wall sometimes and say to yourself, why did I get myself into this? Not trying to scare you away, but it's not as simple as just doing federal returns. You have to do state returns as well, and they can honestly be more hairy than federal returns many, many times. Good question. I know you don't need to become an enrolled agent. You can if you want to get the learning, but you don't have to have that to do taxes. Again, all you need is a PTIN, which is a super low bar, to have to meet. Linda. And final question from Beth Silverman Finkelstein. It's a long question, so I won't read the whole thing, but the gist is, what do you do if you have mutual funds or managed funds in a taxable brokerage account that throw off, dividends and capital gain distributions throughout the year, which you can't control, right? And I've had 2 clients discuss this with me in the last couple of weeks, where it's a good problem to have in some sense, but you have these mutual fund holdings in a regular brokerage account, and many mutual funds throw off capital gains throughout the course of the year. Even if you don't sell any of your fund during the year, the fund itself is still buying and selling securities throughout the year, and all that buying and selling activity gets passed through to you, the fund holder. So if they have any taxable gains that they made within the fund, guess what? You have taxable gains that year, and you have no control over how much taxable gains there are. You just kind of get it when you get it at the end of the year. So people sort of get stuffed with this income that they weren't planning on, or some years it's higher than others. And again, you have no control over it. So the question is, what can I do to minimize it or get rid of it? A few things. You can try to sell it, but if you're selling it at a gain, meaning you bought it at $1,000, you're selling it at $2,000, you're gonna have a $2,000 taxable gain when you sell it. That's not ideal, right? So maybe then you layer in some tax loss harvesting. So if there's other positions you have that are at a loss, sell some of those losers to pair off against your winner to hopefully flatten out and balance out the otherwise large taxable gain you have. That's one option. If you don't have anything at a loss, then that's not really an option, because you don't have things you can sell to trim down your gain. If it's Vanguard, some of their funds allow you to convert from mutual fund to ETF, and ETFs are more tax efficient in taxable brokerage accounts, because they often, if ever, throw off any capital gains. But if you're in one of those funds, chances are you're not getting a lot of capital gains already, because it's probably already an index fund. It's fairly technical, but so point is that may not be much of an option. The only other 2 things I can come up with is either donate some of it. So if you're charitably inclined anyway, find a charitable organization that is willing and able to accept securities as donations. So that way, instead of giving $1,000 in cash this year, transfer them $1,000 to this mutual fund. So you no longer have to deal with the gains getting thrown off, and you can still potentially deduct that $1,000, just like you would a $1,000 cash contribution. And the only other option I have, which I just wrote to a client yesterday or 2 days ago, is, gift it to someone if you wanted to. But again, only do that if you're inclined to gift away money to people in the first place. If not, then don't do it, because you're giving away $1 to save, 20, 30 cents in taxes. That's the tail wagging the dog, or whatever, the cart driving the horse, whatever that is. So that may not be an option either. But nonetheless, if you really want to get rid of the funds, you can donate it, you can gift it, you can sell it. Now, when you sell it, you got to watch out for the tax implications. So that's really it. Now, I say it's a good problem to have, because having to pay tax on something means you made money or you have money. So in that sense, yay, it's good. But if you can have better control over it, or find ways and times where it makes sense to get out of it and into something else, more tax efficient, great. But you have to kind of wait for those opportunities. You don't want to stuff yourself with $100,000 taxable gain in 1 year just because you want to get away from $5,000 of capital gains distributions each year going forward. So not a great answer in that there's no definitive magic trick that you can do, Beth, but those are your options, for better or worse. Okay, that's it for the pre-canned questions. I will now I'll just go down in the order here of first come, first serve. Okay, let's see. Facebook user, what tax changes are up for legislation this tax season that will affect 2020 filing? So one thing right off the bat is unemployment compensation. And this was already on the radar. I made a post in the group, or actually my friend, Tim Mansour, shout out Tim, made a post about it that I shared. month or so back, I guess. Lots of people got unemployment compensation last year because of the pandemic. What many people don't know, or know and choose to not pay attention to, is unemployment compensation is fully taxable. So last year, let's assume you got laid off, you got 20 grand in unemployment. You may think, okay, great. Well, guess what? That's all $20,000 of income you're going to have to pay tax on. And some people don't withhold tax when they have the income, and they're in for a nasty surprise at tax return time. One of the pending legislative changes was to exempt the first $10,200 of unemployment compensation from income for 2020. So for example, if you got 50 grand of unemployment compensation, you would normally have to pay tax on all 50 grand. With this pending legislative change, that's probably getting signed. It's almost certainly getting signed tomorrow by Biden. You only have $39,800 of taxable unemployment compensation, because the first $10,200 is just sliced out, not considered taxable. So that's one thing. So, and I just realized one of my clients I did a tax return for is going to need a tax return amendment because of this. If you already filed your tax return and you had unemployment compensation that you claimed, well, guess what? You're going to need to do an amendment now, because your taxable income is now lower by up to $10,200 if and when this bill gets signed into law tomorrow, as it most likely will. The other wrinkle is that you're going to have to wait for TurboTax or whoever does your taxes for that software company to process this, get these changes into their system, roll it out, test it, roll it out, whatever. So this is why I'm thinking there's still a month until April 15th, but this is why I'm thinking I wouldn't be surprised if, like last year, the IRS extends the tax return time this year again. That's just speculation. Don't quote me. As of now, it's still April 15th. But that's one big one, whoever this is, unemployment compensation. As far as other things, I haven't gone through the bill in detail. There may be other stuff. There's changes to the child tax credit, but I think that's for 2021. There's going to be new stimulus to the tune of $1,400 per person. That's also 2021, but they're going to pay it out now based on 2019 or 2020 tax returns. But the only thing I'm aware of right now that will definitely affect how 2020 tax returns are filed is the change in unemployment compensation, as less of it will be taxable. See what we got here. Teresa Wood, in the interest of converting more from traditional IRA to Roth before RMDs, is there any sense in delaying Social Security income until 70 if it isn't needed, or is this tax tail wagging the dog? So I think the question is it worth delaying Social Security until 72 if it isn't needed? Not quite sure exactly the question, but I think I may know where you're going. So generally speaking, one of the good tax planning opportunities is to delay Social Security as long as possible, particularly for the higher earner if it's a married couple. Not only does that delaying maximize and increase the benefit that person will eventually get, but in delaying, you have to come up with money somewhere to cover your living expenses while you don't have Social Security since you're delaying it. One of the good opportunities for that is to pull forward some of your tax deferred money out of your traditional IRAs, traditional 401ks, and realize, pay tax on it now while you otherwise have not large amounts of taxable income. So there's two ways to do that. One is either just simply take distributions out of your traditional accounts, pay tax on it, spend the money now for living expenses, or do conversions. Either way, you're still paying tax on it now. The difference is with the conversion, you're not spending it, you're just reinvesting it in a Roth IRA for it to continue to grow to eventually be taken out tax-free in the future. So is the question, does it make sense in delaying? Yes, that's the prime example where it makes sense, is to maximize it and pull forward some of your taxable money while you have control over it now. If the question is the opposite, does it ever make sense to not delay and start Social Security sooner? From a tax planning perspective, it depends, but not likely. Well, generally, the tax planning is the other. What I just mentioned is to delay Social Security. But I guess there may be some instances depending on your specific circumstances, where from a tax perspective, maybe it makes sense to start Social Security sooner. But I have to know all the particulars about you to say that. All right. I have an ESOP, employee stock option plan, I think, at my old workplace. What do people do with them? I think the dividends are buying more shares. Thanks in advance, Brenda. So ESOP, God, I always got to look these up. I think ESOP is just regular taxable brokerage account where you can buy shares at a discount in your company's stock. I don't think this is in a tax-deferred IRA type world, or maybe it is. There's all sorts of funky flavors of employee stock incentive plans and things. But if the question is, whether it's pre-tax or post-tax doesn't particularly matter, let's say. The point is you have a program at your former employer where you were able to buy shares. You were getting dividends on those shares. Those dividends were reinvested in more shares. What do people typically do with them? You can do with them like you do with any other former employer plans or money. You can roll them if it's a pre-tax world. You can roll them into a traditional IRA. If it's regular, just taxable brokerage account that you bought with after-tax money, you can roll that over to a regular, to another regular brokerage account at whatever custodian or broker you want. What you want to watch out for is the cost basis. The price at which you paid and the price at which all these dividend repurchases were done at rolls over. So if you do transfer this account to another broker, you definitely want that cost basis info to come with it, because if it doesn't, you're going to have a nightmare in your hands when you do eventually sell these shares, trying to go back and backtrack what price you paid for all of them. So you can either sell them where they are, you can let them stay there. There's no harm in just letting the stuff hang out there forever. Or if you want to consolidate and streamline, you can roll them over into another brokerage account somewhere. Now, I have a client that has some employee stock that they bought through a discounted plan, but it's of a foreign company. So it's foreign, it's non-dollar denominated shares. If they were to be rolled to the custodian I use, the custodian would have to convert them to USD denominated shares. And I don't have confidence that the cost basis info that the client had is going to port over. So I was like, you know what, just leave them where they are. At the current account, I forget what broker it is, but don't roll them to the account that I manage. Leave them where they are. Sell them from there. It's going to be cleaner in the long run. So that's the right answer in that case. But maybe in your case, it makes sense to roll it, particularly if all that cost basis info will come over with it. Are conversions from a 457 to a Roth IRA allowed? I don't know if they're allowed directly. So 457 is a tax deferred plan for public employees, like municipal workers or state employees. Depending on the plan, maybe the 457 has its own Roth part of it. In that case, maybe they'll allow you to convert from your pre-tax 457 to your Roth 457. If not, what you can always do is when you retire, you can roll your 457 into a traditional IRA somewhere. And then once that money's in the traditional IRA, you can definitely then do conversions to a Roth IRA. So you always have that option if the 457 doesn't allow you to convert directly out of the 457. Mavis. Hi, Mavis. I have funds sitting in a rollover traditional IRA. I also have funds in the after-tax bucket of my current employer's 401k. My company allows in-service distributions. Cool. Will the pro-rata rule apply as a result of my having funds sitting in that rollover traditional IRA? Thank you! Exclamation point. Good question. Let me think about this for a second. Yes, the pro-rata rule will apply. So assuming the rollover IRA is mostly, solely or mostly traditional pre-tax money, Mavis, yes. When you're doing pro-rata, you have to look at all of your IRAs that you own. As of December 31st is all the pro-rata rule looks at. December 31st of the year you do conversions. And you have to look at the mix of pre-tax versus post-tax as of December 31st. So yes, if you were to roll your after-tax money this year into your traditional rollover IRA, pro-rata will apply unless you empty out your traditional IRA by the end of the year. Like if you were to then roll your traditional IRA into your 401k by December 31st, leaving your traditional IRA empty, then only what you roll in from your 401 will be your after tax, and whatever else comes along with it will be considered pro rata. Now, here's the other big wrinkle here. When you roll money out of your 401, they may not allow you to roll out just the after tax, Mavis. They may make you do prorated portions of some after tax, some pre-tax from your 401 into your IRA. So that's going to defeat the purpose of pro rata, because you may have pre-tax money coming along with your after tax out of your 401. Yeah. How do you schedule installment estimated tax payments to the IRS after Roth conversion in early 2021 so that you may not be penalized? Or can you wait to pay before April 15th, 2022 without being penalized? So I guess the question is, you already did or will be doing Roth conversions this quarter, early 2021. God. Yeah, estimated payments, that's a tricky one. I did a live about it on my YouTube channel. You can see the replay there. I think I did it in November. Definitely worth looking at that one. I think it's called like How to Avoid Underpayment Penalties or something. There's a lot of different ifs and thens to estimated payments. So ideally, if you're making estimated payments, you're supposed to make the payments in the quarters that correspond with when you had the income happen or realize. So if you do a big chunky Roth conversion in 2021, and let's assume you have no other taxable income for the rest of the year, keep this math simple. You need to pay your estimated tax this quarter, in the quarter you did the conversion. If you don't, and you wait to pay in December or, early next year, you're subject to then have an underpayment penalty, because the payment was supposed to happen in the quarter that you had the taxable activity. That's the basic rule of thumb. The other sort of exception and way out of this, or there's a few, but one of the other ones is if you can withhold taxes somehow. So if you have a W-2 job, or you have Social Security or pension that you can have taxes withheld from, you can do that. Tax withholdings, doesn't matter what point in the year you do them, they're assumed to have happened throughout the course of the year, whereas estimated payments need to be timed in the quarter of when you did the activity. Now, the other exception is if you make your estimated payments equally throughout, 4 equal payments throughout the year, that's another, they'll let you off the hook there. So deceptively simple looking question that has a lot more to it. Definitely check out that video. It did in November, I think, about underpayment penalties and estimated taxes. Sorry, not a great answer, but this is an hour-long topic in and of itself, with slides and charts and things to clearly get all the details across. Is it a good idea to take distributions while at the same time delaying taking Social Security benefits and doing a Roth conversion currently at low tax brackets? Could be. Depends how much you're taking out. My sort of rule of thumb is when you're in low tax years. So for example, you stop working late 50s, early 60s, your wages go away. You do not yet start Social Security, so you don't have that. You may or may not have a pension, or if you do, you didn't start it yet. So your only other income is going to be like some interest from your bank account, some dividends from your stocks. That's about it. Those are great years, especially now while we're in this generationally low federal tax environment. Those are great years to consciously give yourself more taxable income, pay more tax now instead of just letting your tax deferred money sit there for the future. Fill up at least your 10% tax bracket, your 12% federal tax bracket, probably even you're 22, maybe even you're 24. So depending whether you are married or single, if you're single, your 22% tax bracket stops at about $55,000 of gross income, and then your standard deduction. If you're married, your 12% stops at $105,000 of gross income, roughly, less your standard deduction then. So you don't want to let the 10 and 12 go to waste. Give yourself enough income, whether it's through conversions or distributions or a combination of the two, to at least fill up those lower two, probably, maybe even 22 or 24. Now, why I say probably, because what if you have such a small amount of tax deferred income? You only have $50,000 in tax deferred income. Then it probably doesn't matter. Even if tax rates go super high, you're going to have potentially so little taxable income to pull from in future years that you don't have a big tax problem on your hands now. So you don't have to worry about overdoing it now with Roth conversions and distributions. And that's why it's difficult to give people any sort of guidance about how much should be converted and when, because there's so many moving pieces about, well, let's project out how much possible income do you think you'll have in the future, and what will tax rates be in the future, and blah, blah, blah. So anyway, it's not always a good idea. It's not always a bad idea. The answer is it depends, which is the answer to most of these questions. But yeah, you want to fill up your lower tax brackets as much as possible instead of letting them sit idle and then just keep kicking the tax can down the road, having to fill up whatever the tax brackets may be in the future, assuming they'll be much higher. Are dividends and interest concerned earned income? No. Next. Sorry, I didn't mean to be snarky, but no, that's an easy one. They're not. I assumed you're asking for either purposes of Social Security earnings test or the ability to make Roth or IRA contributions, Roth IRA, traditional IRA contributions, in which you need earned income to make either of those contributions. Dividends and interest are passive investment activity. They are not earned income. Mavis again. Hey, Mavis again. Does the pro-rata rule apply when doing an in-service distribution from an after-tax 401k to a Roth IRA if you have the other funds and roll over? Oh, maybe that's the same question as before, Mavis. I think reworded, but I think I already addressed that. Facebook user. I'm 52 years old and opened a Roth IRA in 2020. Will contribute to it till I retire in 2028. After retiring, I will perform Roth conversions every year till my full retirement age. Can I withdraw the conversion principal plus its gain prior to the 5 years of the conversion? So you're 52, opened in 2020. I'll assume you also funded, you got money into it in 2020. So your 5-year clock started January 1st, 2021. After retiring in 2028, so that's 7 years from now, you'll perform conversions every year till you retire, till your full retirement age. And in 2028, you'll be 60. Can I withdraw the conversion principal plus its gains? Yes. Okay. So yes, fast forward to 2028. You'll do Roth conversions from 2028 onward. You will be over 59 and a half. And your Roth IRA will be at least 5 years old at that point, which means all of your distributions from your Roth IRA, from any Roth IRA from that point forward, are qualified for the rest of your life. Qualified means no tax, no penalty. That includes conversions. So you do a conversion 2028, you can take it out the next day. The converted amount plus any gains on it, it will be tax and penalty free based on the facts you laid out here. Oh, good one. I don't know who this is, but yeah. Right. So going back to one of the first questions where I said, I forgot about this, where I said you need to be in an HSA all 12 months of the year to actually contribute the full 12-month worth of annual contribution. So whoever this is, thank you. There's something called the last month rule. If you're enrolled in a qualifying high deductible health plan as of December 1st, I think, of the year, you can treat yourself as if you were enrolled for the whole year. But there's a gotcha. I forget exactly what it is. You need to continue to be enrolled for the subsequent 12 or maybe 13 months. If you're not, so like let's say you drop coverage 6 months in, then you retroactively lose the ability that you had to make the full year contribution under this last month rule. So that can bite you in the butt. So you got to be careful about that. Again, I draw your attention to IRS publication 969. You can look up the last month rule. There's a page or two explanation about it. It'll give you more details. But yes, whoever this is, thank you. I forgot about that wrinkle. Are there any calculators or tools available that allow multi-year tax planning? I currently use an Excel file and make assumptions about tax brackets and standard deductions increases for future years. It works okay, but I don't know what I don't know. I don't know. I'm sure there's probably places that try. There's one called income solver. It's geared more towards the finance profession, but I guess you can probably get it as like a retail user if you want. I haven't personally used it. My sort of not beef, but there's way too many unknowns to get too hung up trying to get too quantitative about this. We don't know what tax rates are going to do, right? I firmly feel they're going to go up. Well, we know they're going up. Firmly feel they're going to go up more, but we don't know how much or when or in what ways. You don't know what the financial markets are going to do. So the money you currently have, the $1 million in your traditional IRA, is that going to be $2 million in 5 years? Is it going to be 1.1 million in 5 years? Is it going to be less in 5 years? Like, you don't know. All the and other things like if you're married, when one of you dies, the tax rates get much worse for the surviving spouse because that person has to start filing as single as opposed to married. That's another big wrinkle. So there's too many what ifs to get too hung up, in my opinion, on trying to really nail down and get to the penny these tax projections. You have to just do it in sort of broad strokes, general ideas. There is no right answer. Only hindsight will be 2020. If you have $3 million of tax deferred money and you have basically no other savings, you have a big tax problem on your hands. You want to try to get ahead of that. By how much and when and in what years to do how much? It's impossible to say how much. No calculator is going to tell you that because there are so many unknowns. It's kind of do as much as you're comfortable doing, right? Like as much tax as you're willing and able to pay today. That's kind of the right answer, unfortunately. So there's probably tools out there. Again, I don't know of any, and I don't get too hung up on it. I have financial planning software that does some basic projections about this stuff, but I tell clients, like, don't focus too much on what the screen says because this is lots of educated guessing, right? We're just looking for kind of finger in the air, broad strokes, orders of magnitude planning. We can't get too granular. This is going to be year by year. We have to see how things play out. And this is always going to be a moving target, how much we convert or take out or distribute as things happen throughout life. After I do a Roth conversion, how much tax should I send in to Uncle Sam? Should I estimate my marginal rate, my effective rate, or something else? Yeah, that's a difficult one too. It depends what other sources of income you're going to have, when you're going to have them in the year, how much tax you had last year. That also impacts how much you have to pay this year. Not to be a cop-out, but there's way too many other bits of info that play into this to say how much you should do or when. But basically, you kind of have to project out, inclusive of this Roth conversion, how much other income you're going to have for the year, how much other tax, what other estimated payments will you make or did you make, what withholdings did you do or will you do, and go about it that way. Okay, here's another comment about someone else uses an Excel model, someone else uses TaxCaster. So those are other people responding. Okay, what's this? Chris. I used to give my kids $10 a month in allowance. After getting sick of finding singles all over the house, I got this bright idea to open up UTMAs, which are uniform transfer to minor accounts for them. Contribute $25 a quarter. Let them pick their own stocks. They chose wisely, and now these funny money accounts, they have 529s, now have significant balances. What happens to these accounts when they reach the age of majority? Do they basically become taxable brokerage accounts with a fresh basis? So I guess these are not 529s. It sounds like you're saying they separately have 529s. These are literally just like fun money accounts. That's a good question. I don't really answer this. So when they hit the age of majority, they become the kids' accounts. So UTMA stands for Uniform Transfer to Minors. So it's basically you're the custodian for these accounts. It's for their benefit. You're the custodian while they're still minors. Once they hit age of majority, which is different state by state, it's generally 18, but I think some states are as old as 21. These accounts become theirs in every sense of the word. They have full control over it. I think they're taxable brokerage accounts now. I don't think basis resets when they get them because I think technically they're already the kids' assets while they have them, even though they're minors. I'm not far from certain, but that's my understanding. I don't do a lot with minor accounts. Most of my clients are late 50s and older, so it isn't much of an issue. And even like grandkids, it doesn't come up much. So I don't know, but I think if they just become the kids' accounts, I think they've been taxable brokerage accounts all the while, and I don't think basis resets. Sorry, that's the best of my knowledge on that one, Chris. Teresa, going back to your question about delaying. So no, you can't delay Social Security until 72. Well, you can. It'd be foolish to do so. So your Social Security stops growing once you hit 70. To delay it beyond that is leaving money on the table. Now, I think I may know where you're going. So you're saying, well, what if there's benefit to further delaying that income to give me the opportunity to do more tax planning, to pull forward more tax deferred money? Would that ever make sense? I don't know. I wouldn't think so. I think you'd be leaving a lot of Social Security on the table. I'd have a hard time thinking that that money you're giving up, you're going to more than make up for an eventual tax savings. Now, I could be wrong, but I don't think I can advocate not taking Social Security at 70 because it won't grow beyond that. So no, I don't think so. Oh, right, here we go. Marianne just commented the same thing, right? Yeah. Who knows if taxes quadruple in the next 10, 20 years? And yes, in hindsight, maybe having delayed Social Security to pay down more of your tax deferred money now may end up being the right answer. But I wouldn't think so. I think that'd be a really drastic scenario of taxes for that to play true. Okay. After retirement, can I use traditional IRA money to pay for the taxes of a Roth conversion? Yes. You can take withholdings. You can take a distribution from a traditional IRA and withhold up to 100% of it as taxes, and that can be your way of paying taxes for your Roth conversion. Just keep in mind, any distribution from your taxable traditional IRA is additional taxable income in and of itself. So if you convert $50,000 and your tax bill on that's $10,000, let's say, so you take a $10,000 distribution from your IRA and withhold 100% of it as tax. Well, guess what? You now have $60,000 of taxable income, 50,000 conversion, 10,000 IRA distribution. So you may need to it's this sort of circular reference math. You may need to take out a little bit even more of your traditional IRA to withhold that much more tax because you keep bumping up your taxable income the more money you take out from your IRA. I knew it was coming. 8606. I'm surprised there weren't more of these. Hold on a second. I'm parched. It looks like there's 5 or 6 questions left. It's already after 9. We'll wrap up these last few, and I think this should be it. Okay. Can you discuss record-keeping requirements for a Roth IRA? Form 8606 lists items to keep, and it lists the basis of all Roth contributions. I have been doing Roths for several years and don't know how to get this information other than going back all previous tax returns. Yeah, I don't know the exact answer about 8606 is I think if you make a Roth contribution, I don't think, but I know you don't necessarily have to report that at all on your tax return. Where you do have to report it is if you make more contribution than you're eligible to. In that case, you have an excess contribution. There's one other example that came up the other day that's slipping my memory. But depending on the circumstances, you may have to report it. But if it's clean and simple, you didn't over contribute or whatever, then no, you don't have to report it. It's not going to show up anywhere on your tax return, including 8606. So that begs the question: how do you know how much Roth contributions you've made? A few ways. You can keep track of it however you want elsewhere. Just on a spreadsheet or something or whatever. You'll get a form 5498 every year. You do a contribution to your Roth IRA. The IRS gets a copy as well. You can simply keep those in a binder somewhere. I think I'm drawing a blank. 8606 may have a line to show Roth contributions. I don't know. I could be wrong on that. If it does, then maybe then you can do 8606s just to have a record of it and keep that with every tax return. But yeah, how do you piece it together after the fact if you haven't already been keeping tabs on it? if it's all with the same custodian, like all Vanguard, for example, they should easily have that. You should be able to ask them, hey, how much have I contributed? They should have that. Or if it's not already readily available when you log in to see it. Or again, just like I said, go through all your prior year Form 5498s that you would have gotten that should be saved online, unless you've been doing Roths for, Roths have been over 20 years. Maybe they weren't available online 20 years ago. But it's just backtracking and pulling together all the data. But I'd start with your custodian and ask them if they have it. They hopefully should. And that would be the easiest. Okay. Roth TSP is an option. So TSP is Thrift Savings Plan, which is the federal equivalent of the 401k for federal employees. Is there any utility in establishing some funds in the Roth TSP for future tax planning or flexibility? Only pre-tax contributions to the TSP now due to high tax bracket, retiring in 4 years. So this isn't specific. So the broader question is there any benefit to doing Roth contributions now? It's not specific to TSP, although I guess it is because you're probably making too much to do Roth contributions to an IRA. But this comes down to like how much should you convert, or how much more tax should you pay today to save yourself some unknown amount of tax in the future? It's a tough one. So if you're already in the 30-something% tax bracket now because of your wages and income, I'm hard pressed to say you should do Roth contributions or conversions now. And, it may be worth taking more tax deferred money, making more tax deferred contributions now to help your tax bill now. Now, those additional tax deferred contributions are just compounding your further future tax issues. So I have mixed feelings about this. If you're in the 22-24% tax bracket, I'd say it probably makes sense to do Roth contributions now, pay a little more tax today for the benefit of saving tax in the future. Again, I can't say that definitively without knowing you and your circumstances. This is just sort of general. My feelings is 22-24% is still not a bad level to have to pay taxes. It's the 30-somethings% where I'm like, that's a tough nut to swallow, unless you got this honking huge multi-million-dollar pre-tax portfolio, $5-6 million bucks or something that's going to be a beast in future years. So I don't know. It could make sense for you, maybe not. A lot of it's going to be sort of a judgment call, frankly, based on you and how much tax you're willing and able to pay now. I don't know if this is the same person. Single, 72, no dependents, 2 pensions and Social Security and Medicare Part B are most significant TSP. I'm not sure if this is the same person, same comment, but 2 pensions and Social Security, you already have yourself a lot of income. So you're never going to be in the low tax bracket for what it's worth, which isn't great from tax. It's good. You'll have a lot of income. That's obviously, I'll take that any day of the week over not. But yes, you're going to have a lot of income. So you may not have a lot of great tax planning opportunities. You'll never be in a low bracket per se if this is a scenario you're in. Okay. Getting there. Yeah, so here's someone responding back to Chris's comment about, does basis reset on those UTMA, those kid accounts? No, so it looks like basis did not reset for whoever this was. So thank you, Tom. All right, I'm running at my voice is getting scratchy here. We're gonna have to wrap this up soon. Kristen, if we contribute to a traditional IRA and immediately roll it over to a Roth IRA, which is called the backdoor Roth contribution, at the beginning of the year, then my husband's S-Corp contributes to a SEP IRA for him at the end of the same year. Does the pro-rata rule apply to the backdoor Roth rollover done earlier in the same year? Yes, depends. So who did the backdoor the backdoor contributions? If you did, Kristen, and your husband did not, then no, your husband's SEP would not impact your proration and backdoor rules, because the I in IRA stands for individual. So any conversions you do, you have to look at your IRAs, your SEP IRAs, Kristen. Those will impact the backdoor conversion you did. Your husband's will not impact your backdoor conversion. But if your husband did a backdoor Roth contribution this year, then yes, his SEP IRA, its balances will impact pro-rata rule for purposes of the backdoor contributions he did, but it won't impact what you did and vice versa. Why would you need to keep track of your Roth contributions? So because I see someone else replied to this. Because of the order of withdrawals of Roth. If you're younger than 59 and a half or your account is not yet 5 years old, when you take money out, the money you take out is assumed to come out of certain distributions. First, all money you take out is money you contributed. Next is any money you converted. Finally is any money that's gains. So if you're younger than 59 and a half and or your account's less than 5 years old, you need to pay attention to that, because if and when you take money out, you definitely need to know what your Roth contributions were, because that could mean, maybe some or none of your distributions will be taxable. If and when you're 59 and a half and your first Roth IRA is at least 5 years old, then none of this matters. Any dollar you take out of your Roth is tax and penalty free, period. Doesn't matter how and when it got in there at that point. But that's why you need to keep track of it. I just did a tax return for someone who had to unfortunately take money out of his Roth early, and he took out more than he contributed. So some of his withdrawal was tax-free, tax and penalty free, because it was just a return of his original contribution, but the rest was him taking out earnings, and he had to pay tax and penalty on it. So that's why it matters, because he needed to, he thankfully kept track of all his contributions. All right, getting near the end here. Tell me more about basis in inherited Roth. How do the kids get info on basis, or does it not matter because it's Roth, and basis really does not matter because they won't be paying taxes? So it doesn't really matter. Basis in the traditional sense of knowing what price securities were bought, that doesn't matter. What may matter is how long the decedent, so the person who died, how long the decedent had the Roth IRA opened before he or she died. And here's why. This can be a rabbit hole, but just like I sort of mentioned before, in order for your withdrawals from your Roth to be quote unquote qualified, two things need to happen. You need to be at least 59 and a half, and your first Roth IRA needs to have been opened and funded at least 5 years. If it's not 5 years, you take money out, you have to pay tax on any gains and potentially penalties as well if you're not 59 and a half. If and when you die, that 10% penalty goes away in the hands of your heirs. But if you did not yet have your first Roth for 5 years prior to the time you died, your heirs need to pick up where you left off with your 5 years, and they'll need to hold that account for the remainder. So let's assume you died 3 years into your first Roth IRA. Your heirs will need to have that inherited Roth open for at least 2 years before they can take out gains from that account tax-free. Otherwise, any gains they take out, they'll have to pay tax on, because the account was not yet five years old, because you died 3 years in, they had it less than 2 years. If, on the other hand, the decedent, the person who died, had a Roth IRA for more than 5 years, then none of this matters. The basis doesn't matter. The people who inherit it can take all the money out the next day, tax and penalty free, or they can wait the 10 years that they have to take it out in the 10th year, tax and penalty free. Doesn't matter. The concept of basis is irrelevant in that case. So again, it only matters if the person who died did not have any Roth IRAs, or the first Roth IRA was not at least 5 years old. Then you have to pay attention to how many years was it. But otherwise, the basis of individual securities is not going to matter at all in any scenario in this case. I like this one. Is this a question or a comment? I guess it's a comment. Okay, so yeah, it's worth a minimal conversion or contribution of $1 to get a Roth clock started. Yeah, so if you don't already have a Roth IRA, it's worth it to get one started ASAP. And it could be as little money as a custodian requires. Some may be as small as $1, just to get the account started, because the 5-year clock you have to meet starts January 1st. of the year you open and fund your first Roth IRA. It doesn't say you have to put a certain amount in, it just says you have to open and fund it. Could be $1, could be $1,000, whatever. Just get that clock started if you don't already have one. All right, looks like we're done here. Last one. How can we find out how long a decedent had their Roth IRA open? It just rolls in as an inherited IRA. No info came with it. Ooh, yeah, I don't know. The custodian that has the account from the decedent, they should hopefully know how long the account was open there. I mean, they will know, so they should be able to tell you that. Now, here's where it's going to be weird. If, let's say that account was only there for 2 years and you don't know, maybe the decedent had other Roth accounts 10 years ago. If he or she did, then great. If he or she didn't, then you got this issue where you're going to have to wait 3 years on your inherited accounts before you can take out the earnings. So I don't know. I don't know how you go about finding this out. I would start with the custodian that had the account when the person died and hope for the best. Outside of that, I really don't know, other than asking maybe the decedent's surviving spouse, if there is one, other relatives, the executor of the estate, although he or she probably wouldn't know, but maybe they'd have some records in conducting their duty as executor, executrix, that would give them some insight into when the first Roth may have been open. But I frankly don't know if there is a bulletproof way to find that out. All right, that is it. I think this was a success enough. I welcome your feedback about this process for next month's episode of this. This went fairly well. Thankfully, I'm happy. Thank you all for the great questions, both those that sent it beforehand and those that plopped stuff up here live. And thank you for sitting. I get kind of wordy sometimes and verbose, so thank you for sitting with me as I ramble on about this stuff. Next week we got a good one. Don't forget to tune in next week. It's going to be Liz Hand, who's another planner friend of mine in Ohio. I'm in New Jersey. She's in Ohio. She specializes in working with single women or women in or near retirement. So we'll be discussing sort of women-specific retirement planning topics next week. So Liz Hand, you don't want to miss that. And it'll be St. Patrick's Day. Maybe I'll have one of those green plastic boxer hats and like I don't know, some Guinness or something like that to celebrate. So that's that. Thank you all again. I will see you next week, and I will see you in the group until then. Take care. Good night.